Ladies and gentlemen, good day and welcome to ANGELONE Limited's Q4 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Hitul Gutka. Thank you, and over to you.
Good morning and welcome everyone. Thank you for joining us today to discuss ANGELONE's Q4 FY23 financial and business performance. The recording of today's earnings call and the transcript will be uploaded on our website under the Investor Relations section. The financial results, investor presentation, and the press release are also available on the website. For today's call, Angel is represented by Mr. Dinesh Thakkar, Chairman and Managing Director, Mr. Vineet Agrawal, CFO. We also have the other senior leadership team along with SGA, our IR consultants. The leadership team will give us a brief overview of the operational and financial performance of the quarter gone by, followed by the Q&A session. There may be certain forward-looking statements during the call which must be viewed in aggregate with the risks that the company faces. With the brief introduction, I now invite Mr. Dinesh Thakkar for his opening remarks.
Thank you, Hitul. Good morning, everyone. I am leading the call after a few quarters. However, let me reassure you that this is temporary. The leadership team at ANGELONE is built on a strong foundation, and needless to say, this professional team is capable of leading not only business growth and goals, but overall communication as well. With Narayan Gangadhar's decision to move on, the day-to-day operation of the company will continue to be led by the team of high-caliber professionals under my active guidance. I would like to take this opportunity to once again state on the record our appreciation to Narayan for having led the organization for nearly 2 years, while wishing him all the best in his future endeavors. We continue to strengthen our core teams as we maintain our focus on immense growth opportunities, keeping in mind our desire to improve customer experience consistently. Our goal is to partner with all Indians in their wealth creation life cycle by offering them all financial products they need as they grow. The team is further strengthened by the addition of Mr. Amit Mujumdar as an Executive Director for Strategic Initiatives of the company. It gives me great pleasure to welcome Amit, who has had a variety of experience in the BFSI, health, consulting business, and has also been associated with ANGELONE in the past. Amit brings deep rigor and experience in the area of business growth and profitability. He will oversee various strategic initiatives that ANGELONE wishes to explore going forward. This is on the leadership front. Leadership team is aligned with the vision of making ANGELONE India's most trusted fintech brand, empowering billion lives, leveraging the power of data and technology. FY23 has been another year of strong performance for ANGELONE, in which we continue to strengthen the business with each passing quarter. We launched the Super App and have seen successful migration and transition of all clients to the new app. It will be fair to say that this was perhaps one of the largest migration in digital space achieved by any company in India within the shortest possible frame. Even in tough market conditions, our performance in FY23 has demonstrated great resilience across various parameters, such as our market share in India's incremental demat account grew by 366 basis points to 18.4%. We concluded the year with a client base of 13.8 million, making us one of the India's largest retail stockbrokers. Our orders, a key revenue driver for our business, grew by 36% year-on-year to 926 million. The underlying ADTO more than doubled to over rupees 13 trillion, thereby expanding our market share in overall retail equity turnover by 57 bps to 21.8%. Our digital playbook very clearly demonstrates the strong foundation on which our business is premised. Some highlights include our total client base grew by 7.6x over the last 3 years, as we penetrated more deeply into Tier 2 and beyond pockets and onboarded many new-to-market clients. Our net revenues correspondingly grew by 4.9x over this period. Our digital model offers significant operating leverage, as shown from margin expansion and a tenfold jump in our profits over the last 3 years. This superlative performance has come without any compromise on profitability or investments to spur the growth of our businesses. The fact that our operating margin has remained above our desired range of 45 to 50% gives us very strong headroom to achieve our aggressive growth targets. Let me share with you some insights about quality of our business the team has built at Angel One. The fundamental principle at Angel One has always been to stay focused on unit economics and run a profitable business, keeping clients at the center while enhancing their experience and wow quotient with the Angel One app. Our business model is geared towards attracting young cohorts who do not have physical access to capital market. These young digital natives have a long runway in their career with sustainable revenue potential across multiple product offerings on our super app. As we speak, approximately 43% of our clients acquired in FY23 fall into this category of less than 25 years in age. Our digital model has enabled us to penetrate deeper into Tier 2, 3 and beyond cities, acquiring such clients and serving them profitably. Empirical data on past client behavior suggests they continue to contribute healthy revenue over a 5-year period and beyond. Our digital business model demonstrates further improved revenue progression as clients continue their journey on our platform. In our Q4 FY23 investor presentation, we have shown some strong data points evidencing this behavior, wherein the robustness of our digital model demonstrates a very healthy LTV to CAC of 7.8x based on first 3 years of aggregate client revenue. We firmly believe that as a client spends more time on our platform and consumes more service, this LTV to CAC has a long runway of growth. This strong LTV to CAC trend further strengthens our mission of aggressively taking advantage of massive growth opportunities in underpenetrated geography while maintaining our robust contribution margin profile. Our seamless digital offering, coupled with our trusted brand, fulfills the basic principle pursued in any multi-generational product suite. The inherent success of our super app strategy is further strengthened by the strong growth in monthly unique SIPs observed in the first quarter of its full-fledged rollout. As we offer other financial products catering to an evolving needs of these clients, we are confident about expanding our relationship across their long tenure, thus achieving the true potential of our super app. Our low fixed cost structure, built on a very stable, agile and scalable digital model, insulates our margin profile under all market conditions. This places us amongst the few highly profitable cash accretive business in the ever-evolving fintech industry. More details are provided in the presentation. We continue to believe that the strengthening regulatory framework across various aspects emphasizes providing stronger guardrails, especially for growing retail investor base. This has been proven with continual growth across the multiple regulatory interventions in the past. The ensuing regulations on client funds management is a further decisive step in building the confidence of retail participants. Our purpose is to collaborate productively with regulators in achieving this goal. I hope this incremental insights have enhanced your understanding of our business. Vinit will now take you through our financial performance, post which we will be happy to answer your questions.
Thank you, Dinesh bhai, and good morning, everyone. FY23 has been a breakthrough year for us as we increased our client base from 9.2 million to 13.8 million clients, as we registered record high net revenue, EBITDA and profit after tax. During these 4 quarters, Angel One has outpaced the industry to gain market share while delivering a strong performance across multiple operating and financial parameters. Our quarter 4 financial year 2023 financial performance continued its strong trajectory, with the gross revenues growing by 9% quarter-on-quarter to 8.3 billion. Gross broking revenue grew by approximately 14% quarter-on-quarter to rupees 5.8 billion. This accounted for about 70% of our total gross revenues for quarter 4 FY23 as compared to 67% in quarter 3 of FY23. Interest income, which includes interest earned from our client funding book and from deposits with exchanges, has remained stable sequentially at rupees 1.4 billion, accounting for about 16% of our gross revenues in quarter 4 of FY23. The ancillary transaction income linked to the turnover grew by nearly 21% sequentially. This accounts for 9% of our gross total revenues. The aforesaid has been achieved due to a strong 20.5% market share in India's incremental demat accounts, 16% quarter-on-quarter growth in orders to 263 million, 28% quarter-on-quarter growth in ADTO to rupees 18.5 trillion, leading to an expansion of 124 basis points in our overall retail equity turnover to 22.8%. Our consolidated EBITDA margin for the quarter stood at 57.5% in comparison to 53.9% for quarter 3. Our quarter 4 FY23 margin has been positively impacted by rupees 300 million on account of reversal of stock option grants. Our consolidated profit after tax from continuing operations increased by 17.1% quarter-on-quarter to rupees 2.67 billion. Taking into consideration the reversal of grants, which positively impacted by rupees 300 million, the consolidated profit after tax on adjusted basis would be rupees 2.45 billion. For FY23, consolidated gross revenues grew by 32% year-on-year to rupees 30 billion. EBITDA grew by 43% year-on-year to rupees 12.2 billion. This translates to 53% margin. Profit after tax from continuing operations grew by 42% year-on-year to rupees 8.9 billion. For FY23, the aggregate dividend payout is 37%, totaling to rupees 3.3 billion. The period end cash and cash equivalent increased to rupees 55 billion. Client funding book was rupees 11 billion, whereas borrowings stood at rupees 8 billion. Robust profitability along with efficient capital utilization led to an improvement in return on average equity to 47.5% for FY23. With this, I conclude the presentation and open the floor for further discussion. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, thank you. Good morning, sirs. Congrats on a great set of numbers. The first one, I wanted to understand, you have mentioned that your margin requirements might go up as a result of streaming of client funds, and the incremental cost could be around 40 crores for 9 months FY24. So just if you could throw some little bit more color on this, why would the margin requirement go up? Is this because you will have client funds to be placed in lieu with exchanges? Some color on that, please.
Sure. If we answer this question.
Sure. So, Arnab, in the SEBI board meeting dated 29th of March, the board approved the framework for upstreaming of clients' funds effective 1st of July 2023. Under this framework, the fund shall be upstreamed only in the form of cash or lien-marked fixed deposits or pledge of units of mutual funds, etc. This means that bank guarantees submitted as a margin to the stock exchanges have been kept outside the purview of the upstreaming framework. So this was allowed earlier, but in this current upstreaming framework, this has been kept out. So this will lead to an increase in the proprietary capital required under the segregation and allocation of collateral at a client level. And hence, the calculation which we've done, this means that it requires additional working capital for the company.
So that would be to the tune of around 600 crores of additional working capital requirement. Would my calculations be correct, sir?
Sorry, I couldn't understand that question clearly.
So, I mean, your additional working, the additional borrowing that may be required would be around to the tune of 600 crores?
It would be around 700 to 800 crores, and the incremental cost for that would be about 40 crores for this 9 months, and tentatively about 50-55 crores on an annual basis.
Sure. Couple of questions on the revenue side. First of all, in this quarter, particularly in the month of March, we have seen very strong momentum in terms of number of orders. Just wanted to get your views on if you think this should be sustainable, or was it a reflection of the market conditions and we can maybe see some normalization going ahead? And also on the ancillary transaction charges that you have, that has also gone up a bit. Although number is relatively small in your mix, but it has gone up quite a bit compared to last quarter. So also wanted to understand what is going on there.
Let me take a question on order first, then on ancillary business transaction. Vinit will answer on that. See, in terms of order, we don't go month by month. There would be, because this market would continue to be a bit cyclical. But what we have seen during all the cycles, like orders, number of orders that we get per quarter or per month has progressively increased. So if you look at the block of 3 months, 6 months, and 1 year, we look at trajectory. When we plan our year, we look at the trajectory based on number of orders which increases on every quarter basis. Every quarter will be having a good month, bad month. It's a combination of different kind of factors which impacts retail participation. But overall, our observation is that during all the cycles, we have seen number of orders from retail have constantly increased. On this ancillary transaction, Vinit, if you can answer.
This ancillary income is linked to the transaction, the turnover charges that the exchanges levy on us, and then we levy on the clients. So this will increase in tune with the increase in the ADTO. So as you see, the ADTO quarter on quarter has been growing, and that is linked to the increase in the transaction charges or ancillary transaction income, as we call it.
Sure, sir. And Vinit, on the interest income part, what you report as part of your P&L, has there been some kind of reclassification between interest income and other income?
Yeah, we've consolidated the income which was reflecting in two parts of the financial statement into interest income. Otherwise, there is no change. Just for the ease of understanding.
Okay, so now your interest income will have the margin funding book interest income plus your float income, as well as your other own income from your own proprietary book. Would that be correct?
That's right.
Okay. Understood. And lastly, couple of things on employee expenses and other expenses. If you can give some color how to think about these numbers, because other expenses have gone up this time. And employee expenses have come down slightly, X of the ESOP cost related. So if you can give some color, I could think about this.
So in quarter 4, the employee expenses, other than the ESOP expenses, have come down primarily due to some reversals in the provision of variable pay, etc., which we made throughout the year. That's the only impact. Otherwise, there's no major change in that.
Okay, and other expense, will it remain close to this 200 crore mark going ahead?
Yeah, so other expenses, a large driver of the other expenses are the client acquisition cost. So as we keep on increasing the acquisitions quarter on quarter, this cost is going to grow. It's a variable cost. And other costs are primarily on account of cloud expenses, which again are linked to the turnover or the volume that happens on our platform. So that also are going to grow.
Sure. Last question on the ESOP side. So if you could highlight, the reason for reversal of grant and any reversal we would expect to see.
I'm sorry, sir, your voice was breaking. Can you repeat, please?
Yeah, so I was asking on the ESOP cost, if you could highlight the reason for reversal of the grant and any subsequent such reversals if we can expect in upcoming quarters.
Yeah, Vinit, you can take this.
So in terms of the future impact of the reversal, there will not be any future impact because once the stock grants have been reversed, whatever cost that was there, we've taken the reversal. So there's not going to be any impact in the future.
Okay, that's helpful. Thank you so much for all your answers.
Thank you. We have our next question from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, morning all. Thanks for taking my question. So first is on the other expense, right? If I look at slide number 24, printed slide 24. So you've been saying that the other expenses are sort of elastic, right? But if I look at the cost for second quarter FY23 and the customer additions in Q2 FY23 versus Q4 FY23, right? The customer additions have only gone up from 12 lakhs to 13 lakhs, but other expenses have shot up 30%, right? So what explains this? I mean, if you can split it out in terms of the marketing expenses, maybe some branding expenses, because this is not indicative of elasticity, or if I'm reading out something wrong in this numbers.
See, you have to read this way that what we are showing as a variable cost, this is something that we can control in bad market conditions. So most of the cost, what has been shown, like a finance cost or commission that we pay to subbroker, or a variable cost, which is combination of marketing and all that. So that can be we have levers to control that. Now, on your question of that cost of acquisition, how much we acquired quarter 3 and quarter 4, I'll ask Pratik to reply this on why this cost varies. Because as we said that we are going into an area where actually pockets which are under-penetrated, which are difficult to capture. And Angel has been very successful in terms of acquiring customers who are in this kind of those pockets and an age group of around 25. So it is really unique to Angel that we have acquired those customers and we are profitable acquiring those customers. So as we are going deeper into this pocket, these are the pockets which are growing at a higher rate. And because of our unique approach in terms of we acquire customer, we see that their journeys are creating revenue and we are profitable in terms of each and every acquisition that we do in this kind of cohort. Our cost definitely would not be comparable to previous quarters we are referring to that. So Pratik, if you can just throw light on that.
Sure. Thanks, Dinesh bhai. Mr. Mittal, just to add to what Dinesh bhai has already shared with you, broadly the 8% incremental market share, if you look at it, or 8% increment in number of customers, is come in an environment where the actual additions in the demat additions in the industries come down, right? So while the industry additions have come down, we have actually expanded both the number of customers and we've also expanded our market share in the new acquisitions. And this primarily is a function of the acquisition engine that we perfected, looking at the younger customers and looking at tier 2 and tier 3 geographies to expand our reach. As far as the break-even on these customers is concerned, we continue to break even within 2 quarters. So we are comfortable with our product experience and customer experience, and we know that once these customers come in, we are able to engage them meaningfully and continue our both our acquisition market share and the profitability of these clients. Both of them are conserved, and hence we are definitely very comfortable about the increases that we might see temporarily. And the long-term building block on this will continue to remain the LTV by CAC that we have shared in the presentation, and that, as you've seen, continues to remain at 7.8 for the 3 years, the first 3 years, and it continues to add enduring revenue to us in the long term. So as long as we're comfortable of that, we will continue expanding.
And 1 second, our revenue officer would like to add something. Devendra, you would like to add on this last quarter acquisition?
Yeah. Hi, Sayesh. So I think from quarter 3 to quarter 4 point of view, Sayesh, the number of sales has grown by almost 30% as mentioned, and I think the cost in terms of acquisition also grown in line. But the overall the overall performance remains as we run by we are a growth company. We are driving growth, so we are going to enter new pockets, and we have been entering pockets in a very profitable way, where we maintained our break-even points at around 2 quarters. So that's the 2 things that has been there. But no, just to answer that part as well, I think the quarter 4 sales has also grown by 30%, which is in line with what you're saying.
Right. Because if I look at the cohort-based revenues, right, because if you're saying that in a difficult demat addition environment, if you're going out and spending higher expenses on a per customer basis, but the incremental revenues which these new customers are contributing, I mean, in no way we understand even from the ecosystem is that they'll be contributing in such a way that the payback period would remain at 6 months. So, I mean, the numbers don't seem to add up. I mean, what kind of efficiencies are we looking at? Because the payback period will definitely shoot up, right? And if you could also give out the... Yeah, please, go ahead.
No, currently, whatever cohorts we are acquiring, we give current position. Whatever we are saying 6 months, it is based on this current quarter. So the way we analyze is that whatever cohorts we acquire every month on month, so whatever cost you are seeing, we analyze based on what kind of revenue we'll get from those particular cohorts. So what we are mentioning right now is based on current cohorts that we have acquired.
Right, and if you can please quantify the expenses which we have recorded in this quarter and maybe for the full year.
Vinit, do we disclose cloud expenses separately?
No, we don't disclose the expenses in that detail. So when we release the financials with the schedules, we'll have some data around the other expenses.
Right. And one last thing is on the employee expense. So if you can please, give out the split between your employee in your staff cost, what proportion would be fixed and what is the variable component?
Vinit?
Yeah. So typically the increments, the variable pay and the ESOP costs that we on board as part of our total cost are variable in nature and can be managed or reduced.
Right, and of our overall staff cost, what proportion would be variable pay? I mean, my question was around that.
So, total of all of these would be about 30-35%.
35%. And of this 30 crore reversal in ESOP expenses, what proportion of those ESOP reversals is attributable to the CEO exit or the ex-CEO exit?
The entire 300 million is on account of that.
Oh, right. Got it. This was all from my side. Thanks a lot and all the best.
Thank you. We have our next question from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Yeah. Hi. Can you break down the cash and cash equivalents and investments into the cash which company has and cash which is for the margin requirements?
Vinit?
Yeah, the cash and cash equivalent of 55 million, of that almost 40 billion is the client's funds, and the rest is the net worth of the company that has been used for margins or.
Got it. Thanks. That's it.
Thank you. We have our next question from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Congratulations on good set of numbers, and must appreciate the kind of presentation is uploaded every time with more granular detail on the various aspects of the business. Coming to my first question, I would just wanted to extend the point on that 40 crore impact, what you've spoken. Is it pertaining to if the client gives 100% collateral against which you have to kind of deposit cash to the clearing corporation?
Yes.
Yeah.
So segregation of margins, that the client has to bring in at least 50% in cash and 50% non-cash. Where the clients offer more non-cash collateral, there the broker has to pitch in with their prop funds, which can be in the form of cash, FDs or BG. So this is one reason why the working capital requirement increases, and of course there is also this element of segregation of margins across various segments, where also we need to have some margins with the exchanges.
Okay. And secondly, could you just explain this the slide 7 in a slightly more detailed manner?
Yeah. See, here we are trying to, there were lots of questions in terms of what kind of LTV to CAC broking kind of company can expect from their client. So we have kind of an historical record of people in that physical era where we have seen that the customer life extends beyond 5 years, and kind of revenue that we get from customer drops, but gradually it continues or gets steady after 3rd year. So when we are moving to digital era, we are saying that we are seeing an improvement in customers' revenue or lesser drop of customer revenue from 1st year to 2nd year and from 2nd year to 3rd year. And if you go by kind of an empirical data or evidences which are there, the customer life cycle, even in physical era where actually there used to be lots of customer revenue loss because of dealers are trading and all that. In digital era, because clients are downloading an app, it remains on their phone. We are not only seeing improvement in progressive years, but this can continue beyond 5 years. So this is what we are trying to compare, that customer revenue from stockbroking. It is not just for a year or two, it continues beyond 5 years. And in digital era, we are seeing improvement of customer revenue from compared to what we were seeing in that pre-digital era.
If I've understood it correctly, a customer acquired in H120 gave 100 rupees, the cohort gave 100 rupees. In H121, they gave 69 rupees of broking revenues. Is that understanding correct?
No, I'll ask Devendra to explain you the slide properly. Devendra, if you can just explain the slide properly. You are on mute, Devendra.
Yeah, sorry. So hi Payesh, can you just explain, can you just ask the question again for simplicity and clarity?
I just wanted to understand, so is my understanding correct that in that slide 7, H120 you are mentioning 100%, and in the year 2 you are mentioning that as 69%. So is that understanding correct, that the customers who gave you 100 rupees, customers that you acquired in H120 gave you 100 rupees in H120, in H121 they give 69 rupees, and in H122 they give 63 rupees. Is that what you are showcasing out here?
Yes, correct. Prayesh. So that's what it is, that in the year 1, they have given us 100 rupees, and in the year 2, if I look at H1 20 clients, they give 69 rupees, and then the year 3, they give 63 rupees. If you look at the recent most quarter, where clients have completed year 2, this is completed data of clients. So H2 21 gave 100 rupees, and the year 2, they gave 86 rupees to us.
Okay.
Yeah, that's right, Prayesh.
Okay, got that. And my third and last question would be on the float income. There is a lot of thing now that ASPA may or may not be get implemented. There could be forced while it's voluntary right now, but eventually it will be implemented in some form for the secondary market. So just wanted to get some numbers around the float income that we generate and which could be at risk for, say, whenever that ASBA gets implemented. And also, Dinesh bhai, if you can throw some thoughts on how do you see the ASBA implementation really happening in the industry, whether that will lead to consolidation or what proportion of customers would be kind of willing to move to ASBA. Some thoughts there that will be helpful.
Yeah, see, what we have seen is that whenever there is kind of like regulatory changes which helps bring in more confidence in retail, we see a huge improvement in terms of participation from retail in equity market. So we are very bullish. Every implementation that regulator is doing is bringing more confidence of retail customer, and we are seeing huge penetration. If you look at like our TAM, almost like people who are holding PAN card and all that, it is beyond 50 crores and all that. But what is stopping them from coming to the market when markets are giving such an excellent return is somewhat they are not finding this market to be very kind of like reliable or trustworthy. So my opinion is that all this kind of like changes which happens, it happens to expand the market, and people like us who have a huge market share, only they gain further market share when these are implemented. So my view is that ASBA right now appears to be a bit far away. Right now we are talking about gearing up for upstreaming and all that. ASBA does not seem to be coming in near future, but whenever it comes, we are not seeing a kind of like there can be impact in terms of float income and all that. But we are more dependent on broking income and other income related to financial services. So I feel a huge consolidation will happen in terms of clients would move towards more digital kind of like brokers, because they have a perfect ecosystem to take care about online transfers and all that. But point is that even RBI and banks should be ready with those kind of like real-time technologies. According to my opinion, it is a bit time away from here.
Okay, got that. And lastly, any thoughts that you have that whether the brokerage rates should increase or who will blink the eye first, because the cost of operations, cost of compliance, by every announcement of the regulator is just going up. Do you have any thoughts around as to how the brokerage rate should kind of move and who will blink the eye first? Because next year you have a 40 crore impact, possibly analyze this the 60 crore impact because of the upstreaming of funds. There is additional, I think, regulator had put in on identifying fraudulent accounts that system has to be in place. So there are many compliance costs that have gone up. So do you think this 20 rupees per order is a fair cost, or do you think that will be that will have to be increased in the near future?
See, for industry, this is a huge cost, operating cost increases, as well as if you look at technology and all that, regulators coming heavily on having proper like data center and proper kind of like cyber securities and all that. What it suggests that you need a scale to be into this business. A medium size or a small size brokerage house cannot continue to be profitable unless and until they raise the rate. But players like us who have a huge operating levers, they are very kind of like profitable, because incremental business what we get straight away, it results in improvement in our bottom line. So I don't think that bigger brokerages like us would think about change. That is my personal opinion, because we are seeing we have a huge operating margin, and we would not like to be very much concerned about few costs increasing here and there. If you look at total kind of like the way we do compliance and the way we handle technology and all that, already we have taken lots of kind of an upfront cost to fulfill that requirement of regulator. With this also, we are saying our margins are quite decent enough. Every business works based on operating margin. If at all we are getting 50% and we can accommodate all cost, and because of scale we get advantage. So it will just add up to our advantage of getting more market share when mid-sized broker is unable to like adjust this cost in their cost structure and increase the rate. So that is where I feel people like us would be having, organized like us would be having an advantage of more dependent on acquiring or getting more market share and offsetting this increased cost.
Okay. Got that. Thank you so much and all the best.
Thank you.
Hi, Prayesh. Just to add on your first question, right, which was around slide number 7, just to give you a little more color on the data that we've shown there. If you look at the pre-digital era, for any customer who used to give 100 rupees in year 1, year 2 used to become 47, and then year 3 used to become 32, and then it would become stable at about 26% up into an annuity business. So what we have done when we are showing this LTV information to you, we are showing that 47%, which used to be in year 2, has now improved to 86%, and 32% in year 3 has now improved to 77%. So, and hence what we have done is that in the model we have taken the current behavior of the customer cohort that we are seeing, and we modeled out for every 100 rupees that we're getting in year 1, we are taking 86 rupees for year 2 and 77 rupees for year 3. And we also know from our historical experience that this customer is going to stay with us for the long term and will continue to give us revenue at a stable rate over a window which extends beyond the 5 years that we have modeled here.
That's helpful, but just one line item in that estimation, the slide 8, what is the direct cost that is at 100 crores in year 1 and falls to 60 crores in year 2 and year 3?
Prayesh, this is the cost to serve the client. So the first year cost that you're seeing at about 100 crores, it includes the cost of onboarding the client, and thereafter whatever is the cost to serve the client, the direct cost.
Okay, so roughly around 40 crores is what you're saying is onboarding, and rest is kind of closer to servicing.
Yeah.
Yeah, got that. That's a very helpful, and this is a very interesting slide that you have put across. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. Kindly join back the queue for follow-up questions. We have a question from the line of Nidesh Jain. Please go ahead, sir.
Thanks for the opportunity. Sir, on the slide 7 where you explained the cohort data, how is the trend for clients that we have acquired in FY22 in FY23? I think that data we have not shared in that cohort. And the clients that we acquired in FY21, 2 years hence, how is the behavior there?
Pratik, if you'd like to take this question.
Nidesh, we have shared the data for the clients that we acquired in financial year 2022 in the next slide, which is slide number 8. So this builds a scenario where we are saying that for those clients that we've acquired in financial year 2022, what was the revenue that we generated only from those clients in that period? What was the upfront cost that we incurred, and then going forward, what is going to be the revenue based on the trajectory that we are seeing in slide number 7.
Yes, I think in FY23, in slide number 8, it's estimate. It's not actual data for FY23. Is that right? Or based on the clients, how they have behaved, FY21 clients, how they behaved in FY22, we have extrapolated that the clients that we have acquired in FY22, they will behave the same way in FY23.
Yes. So in the second year, when the clients, those that we have acquired in financial year 2022, when they move, some of them have moved to the second year and some of them will move to the third year. So based on the trajectory that we are seeing, their revenues will move in this progression.
Well, I think it would be actual data, not an estimate for FY22 or 2023. That was one observation. Second is, sir, the other operating expenses that we have seen increase. Is it reasonable to assume that the acquisition cost per customer has gone up now versus what we used to do in the past? Though break-even period still remains less than 6 months, but per unit cost of acquiring a customer has gone up. Is that a reasonable understanding?
See, we don't disclose cost of acquisition, but just to answer your question, see, as I said, that as we are moving towards deeper kind of like pockets, like tier 3 and beyond, what we look at business unit, when we have certain cost of acquisition, whether that unit is profitable. So we don't clearly focus on increase or decrease in cost of acquisition. Currently, our focus is on increasing market share. So whichever pocket we feel that this LTV to CAC is profitable, or we can achieve a certain X on that, we try to go into that pocket and get a new set of customers. So our current focus is on market share and LTV to CAC.
Sure. And then lastly, on the last earnings call, we have mentioned that we will move more towards LTV to CAC framework, which may lead to increase in operating costs, because historically we were focusing on payback period of 2 quarters or less. Now we will be moving towards LTV to CAC model. So that movement has happened, and consequently, how should we think about EBITDA margins in FY24?
Yeah. So that movement has happened as promised. That's the reason the slides are included, that we will be now tracking LTV to CAC. So now it is not that this thing like operating cost will increase. Now we are more kind of have visibility in terms of what revenue we can expect from a customer when it comes to projecting revenue for 5 to 6 years from the same cohort that we are acquiring. So based on that, we are fine-tuning our model such a way that wherever we feel that we would be able to maintain operating margin of 50%, we would like to go aggressive in terms of acquiring those cohorts. So that's the reason we told that we would be moving our model towards LTV to CAC, and we will be disclosing all these numbers every quarter. But our focus would be to maintain this operating margin between 45 to 50%. Our focus would be to increase market share. Our focus would be to become a leader in this industry. We need to take very unconventional kind of step where these cohorts which are profitable, we should not avoid them.
So, Nitesh, the purpose of including these slides, as Dinesh mentioned, is just to bring that there is a long-term visibility in terms of the revenue and the profitability or the margins that we expect from clients that we acquire. Otherwise, what was happening is we were fixated with a payback period of 6 months or 7 months or 5 months, and we were not looking at revenues beyond that. So what we want to portray here is that in our business, once we acquire a client, there is a multiple year revenue profile that the client has, and that is what we want to portray. So we take the cost upfront, and then there is a strong margin profile, a very strong contribution margin that these clients give over a multiple period.
Sure, sir. This is just one follow-up on the Super App. There we have seen that the mutual fund SIP has almost doubled after we have launched mutual fund on our Super App. But that will not be a revenue generating stream, because I believe that most of these will be direct funds. What are the rollout plan for other financial service products which will be revenue generating?
Yeah, we have a head, Saurabh, who heads this kind of other income on the Super App. So we have started this journey of mutual fund just 1 quarter back, and we have achieved a good kind of I would say uptick from that. So I would ask Saurabh to explain about other journeys that we are going to include on our Super App. Saurabh?
Yeah. Thanks, Nirmay. We have already launched mutual funds in the quarter starting January, and in 2 or 3 months we have seen the number of SIPs grow to X. The other products that we intend to launch this year primarily fall into the unsecured consumer lending space. So where we'll be acting as distributors to begin with, and then move into creating our own risk models. So I think lending, unsecured consumer lending, just to answer your question, unsecured consumer lending for the retail space will be the key focus area for us to generate revenue in the future. We'll also be delving deeper into the insurance business going forward.
Sure, sir.
Does that answer your question?
Yes. Thank you. That's it from
Thank you. We have a question from the line of Ajox Frederick from Sundaram Mutual Fund. Please go ahead.
Hi, thanks for the opportunity. Sir, I have 2 questions. One is on the number of orders per NSE active client in the F&O space. If I do the math, it used to be about 40 orders per client, and that has jumped to 50 orders in the quarter. So the last 8 quarters it used to be 38, 39, 40. But certainly there's been a substantial jump in 4Q FY23. Can you please help me understand that?
Vinit, do we disclose this number of order, or it is calculated like pattern calculated?
The segment-wise breakup of the orders per client. So that
Yeah.
Okay, fine. Devendra, if you can just answer this phenomenon.
Yeah, thanks, Dinesh bhai. Yeah, hi, Frederick. So, Frederick, when you look at NSE active client base that we overall looking at, and it's driven by overall investor category of clients. When you look at the whole industry, this number is driven by investor category of clients. And when we look at our business, basically, it is driven by orders, where orders is really what is driving it, and where various segment penetration like F&O, commodity, currency, MTF, and other product categories that will play a role. So from an overall point of view, it's not right to look at compare these 2 matrices, because they are not in the same space. One is driven by the overall investor, and business is rather driven by investor plus other categories of product that we distribute, and then we provide on our platform. So from an overall point of view, I would say that we should not relate the 2 in that sense.
Okay, got it. And sir, again, since our persistency is getting better and we have good visibility, why do we stick with a 45 to 50% kind of an EBITDA margin? Because the contribution margin is very attractive, and we are going to enter products which are going to give us better contribution. So, what makes us conservative is my question.
Yeah, we are not conservative. What we are saying that cohorts that we acquire because of digital model, that particular cohort, they improve on their contribution margin. But because we are into kind of an investment phase where we want to become a kind of like most trusted brand in fintech, we would be into this investment phase for a few years. So when we are investing, we are conscious about not to go overboard, but be within that reasonable limit of whatever additional cash we are generating. Some amount should be put on innovation and upfronting on new technologies, acquiring new market share. So we would be conscious about spending and maintaining this margin, operating margin of 45 to 50%. Having said that, that does not mean cohorts that we have acquired over their margins will keep on increasing. As you saw that what we have shown in that page number 8, that cohort that we acquired in 22, that will continue to improve on their contribution margin. But because we are developing this kind of super app, we had developed the super app for this year. We have launched it. We are launching mutual funds. We'll be launching lending product, insurance product. We will continue to be into kind of like heavy investment phase, where we would not lose an eye on operating margin between this 45 to 50%, which includes investment in all kinds of like new technologies and acquiring customer for those cohorts.
That is very helpful, sir. Sir, what is the ESOP outstanding right now?
Sorry, I did not get your question.
The ESOP cost, which will be coming in the coming quarters.
Yeah. So you want to know what will be the ESOP cost?
Yeah.
Vinit?
The current year full ESOP cost is about 53 crores. As against that, the ESOP cost for the next year tentative is going to be about 110 crores, but that includes cost for some PSUs that have been granted, which is about 85 crores. So only for the RSUs and the stock options, it's about 25 crores. PSUs have been granted considering a very stretched business growth. So unless we achieve that stretched business growth, we are not going to
I will answer that, Vinit. So, normal ESOP and RSU would be around 25 crores, as Vinit said. This year, as we are ready launched, we have launched Super App. We have worked out a stretch target for people. If they achieve that, then we have made allotted PSUs for those segments and those targets.
Okay. This is very helpful, sir. Thank you and all the best.
Thank you.
Thank you. We have our next question from the line of Anand Bhavnani from White Oak. Please go ahead.
Thank you for the opportunity. Two questions. One is, there is a talk of extension of market hours for keys. So,
I'm sorry, sir, your voice is breaking.
Give me a second.
Sounding muffled.
I hope this is better.
Can you speak again, please? Can you repeat your question?
Yeah.
No, I'm sorry, sir. It's still muffled.
I'll come back in the queue.
Thank you. We have our next question from the line of Pallavi Deshpande from Samiksha Capital. Please go ahead.
Yes, sir. Thank you for taking my question. Just one was an observation on the rating on Play Store for the app. It seems to have declined. That 4 versus some peers now, higher than us. Just any comments on that? And second one would be if you could share any market share targets that you may have in terms of the ADTO business.
What was the second question?
Any targets on market share for the ADTO business?
Okay, let first Ankit cover this rating of our app.
Hi, Pallavi. Play Store ratings, which is Android app ratings, are a reflection of the reviews and ratings combined, and it's a moving number. Since we were migrating from the old app to the new app, obviously there was an element of surprise to a few customers, and that's why there was a fluctuation. Earlier also, by the way, we were at, as just mentioned, we were at 4.2. The latest number, by the way, as of now today is 4.1. And it's a moving number, and we are very optimistic it will touch 4.5.
Right. And second one would be on the market share target.
No, what is the...
Is it on market share of ADTO you're asking?
Yes.
So what exactly is your question on market share of ADTO?
No, so would we have a FY24 target in terms of market share there? And this is actually tying in with the earlier question that was asked, with regard to price increases. So, is it the market share here versus price?
And
right.
Increase in market share and all that, that would be more of a forward-looking statement that we don't disclose or we don't say. But in terms of rates and everything, already have answered.
Right.
That's the point
that I was just trying to tie in that, would that be, is it market share that drives us right now, and is that why we
definitely. We will be spending to gain more market share. Already we have done it every kind of quarter. So focus would be increasing our market share. Yeah, right.
Right. And on the operating margin, I think you mentioned 45 to 50. So that implies a decline in FY24.
That includes even upfronting costs that we take for new technology, investments that we do in new segments, and investments that we do to acquire more customers. Because when you acquire a customer for that year, our operating margin is not same. So what I was saying, broadly, we will be guided by this operating margin of 45 to 50%, but if you look at cohort-wise, our contribution margin tends to for every cohort that we acquire.
Right. Got it. Thank you so much.
Thank you. We have our next question from the line of Deepak Sonavane from Haitong Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. So my question is regarding our fees and commission expenses. So for FY23, we have reported around 641 crore of the fees and commission expenses. And as I understand correctly, the majority of that will be to the sub-broker, paid to the sub-broker. So apart from that, are there any agencies, are there any stakeholders that we pay commission or else fees just for acquiring a client or else just getting those clients, getting those clients active? So do we account that expense as in these fees and commission expense?
Vinit will answer that, and post that, Ketan can take this question.
Yeah. So the fees and commission expenses is purely the sharing of broking revenue with the sub-brokers, with the authorized persons, for whatever revenue that we generate from that channel. Nothing else is recorded in that.
So this is just only authorized person and not, any entity, that you acquire clients through online channels, right?
No, this is only sub-brokers.
Okay, got it. Thank you.
Thank you. We have our next question from the line of Jignesh Kamani from GMO. Please go ahead.
Yeah, hi. Just on the activation rate, so it has been declining since last couple of quarters. I just want to know the reason behind it and where it should lie. And if you further dissect, is more due to the new client added in last 2-3 quarters where the activation is lower, or in the old client also we are seeing some fatigue and their activation is declining?
First of all, we have shown the slide where we are clearly showing that activation and number of orders are not really connected. As we acquire more customer, few customers become active in that quarter, and when market condition changes, we see lots of more customers getting active. So overall, what we have seen is that there is no strong correlation. If you check slide number 38, where we are clearly showing, though based on market condition, activation ratio changes. But if you look at number of orders, they steadily grow. So our assumption is that as market, currently this quarter market was not great. There were no volatility and no interest from retail as well as even other participants. But as this concern market movement improves, we will see a better activation. But when it comes to number of orders, we are saying that steadily grows.
But if I further dissect it, so if you 2 or 3 year old client, there also activation rate has declined, or is mainly because of the new client is not becoming much active because of the current market condition?
Devendra, you'll be able to answer this?
Yeah. Thanks, Dinesh. Right. Jignesh, right? So Jignesh, it's similar for old and new clients because it is the overall buoyancy of the clients. People are interested. So we are looking at a 12 months. People who have invested at least once in 12 months because NSE Active represents that, and this is primarily driven by how the overall market sentiment looks like, which have been subdued in the last quarter, and it affects the new customers as well as the old customers in a similar way. There's not much different. Actually, for old customers, it's little lesser, but from an overall point of view, it affects them similar way. There's no difference between the two.
Understood. Thanks a lot.
Thank you. We have our next question from the line of Aegis Lakhani from Unifi Capital. Please go ahead.
Yeah, team, firstly, again, credit to all of you for putting out the incremental information, quarter after quarter and providing incremental insights into, the business. It's really very helpful. So credit to all of you for that. Dinesh, my one question is that, again, on slide number 7, the data that you've put out, in the post-digital era for the customers who are far more sticky as compared to the pre-digital era, the counter narrative to that is that, Dinesh, that they've not seen market cycles. So how would you comment, or how would you advise us to think? Because these are fairly new customers. Again, they've not seen seasoning and maturity across cycles. So how do you expect their behavior, or if you could comment a little on that?
Yeah, that's an excellent question. when we are referring to empirical data now, it covers almost like your dot-com bubble, your global financial crisis. This is a sample kind of like what we are creating in front of you from FY15 to FY19. But if you ask my experience, that clients who are active in that post-digital era also had a similar trend in crisis situation when market dipped, and again when it recovered, we saw same kind of trend panning out. So when you say 5 years and beyond, it includes one bull market, one bear market, and all that. So behavior of a customer who comes to the market remains same. So what we are saying is that if pre-digital era, this was a kind of trend, a customer what we acquired, it is not that they remained only when markets were good and they ran away when markets were bad. They remained in the market for 5 years and beyond. Same thing we are going to see in the digital era also. Like it is not because of COVID or because of that they are new to market. People who were new to market in 2001 or 2005 to 7, if you remember, there was a huge bull market. But post that also, when we calculated 5 years block and beyond, it remained almost same. So when we take an LTV of a customer for broking, we usually take 5 years and beyond and then try to map it in terms of how this behavior would be from 1 year to 2 year and 2 year to 3 years and beyond. So if you look at slide number 18 that we have shown, in that we have shown that despite all different market cycles, when we have seen this kind of like huge kind of volatility in Nifty, retail participation has progressively increased. The number of orders you see has progressively increased. What it means, every customer who was acquired in that phase remained active beyond certain period. It is not just only in that phase when markets were good, they were active. After that, they become inactive. So if we take the whole cohort, what we look at that active customer base, they are the one who contribute in the market. So when you look at active customer base, it does not drop like suddenly. If you look at NSE active client base, data is available to public. So when we go into granularity of our data, we have seen, I'm talking about last 15, 20 years, if customers that we acquire remain active 5 years and beyond. So we are showing that trend in slide number 7, that what it was historical and how we are seeing improvement in digital natives. The reason for improvement, as I said previously, in physical era, when we acquired a customer, it was served by a relationship manager. If they attract, we lose that revenue from that active customer. In digital era, what we are seeing, when a customer is acquired, they remain on our platform and are served on our platform. That's the reason we are seeing increment from first year to second year compared to previous era.
Got it, Dinesh bhai. That was very helpful. And Dinesh bhai, going into the next year, what are the key metrics that you would track for growth that you are tracking? I mean,
same as I said that we have been successful in terms of acquiring customers from tier 2 and beyond. So we would remain aggressive in terms of acquiring those customers. Our model has been successful in terms of acquiring those customers and getting decent revenue. So if I look at operating margin from those customers also is very attractive. Plus we have added mutual fund journey. So definitely that attracts stickiness of customer who wants to invest in some other product apart from stock broking. Progressively in might be fourth quarter of this financial year, we are going to introduce third party lending and all that. So we'd like to be distributor of all services. That's the reason I said that this year also we are looking at a kind of like being into investment phase, and we have worked out kind of stretch target for our team, and we are confident that we will be able to get good market share in areas which are non-broking areas. So going forward, our focus now would be not only achieving a good position in stock broking kind of like area, but also achieving a good position in mutual fund, starting our businesses in lending, as well as going a bit aggressive on insurance side as well.
Got it. All the best, Dinesh bhai. Thanks.
Thank you.
Thank you. We have our next question from the line of Sanket Goda from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. My first question is basically on the same other expense cost. So if I do the math, is it fair to assume that to maintain the EBITDA margins around 45 to 50, this overall expense will be like 27 to 28% of the total fee and commission income? That's the way you want to operate these other OpEx, given you said it is largely variable in nature?
Vineet, please answer.
Yeah, it remains in that trajectory. So if you see, the net income is about 2,300 crores, and our other income is in line. Sorry, the other expenses in line of about 25% or so.
Got it. And the question on the margin given to the clearing corporation, just wanted to understand that the float income, what you are going to earn from the clients will remain, but the additional borrowing cost will be the additional cost which will impact from FY24 onwards, right? So the float income is not going to go away. It's only if ASBA becomes the reality, the only way to to trade, then you have a challenge with respect to the float income. That's my understanding is right?
Absolutely right. So there is no impact on the float income under the upstreaming mechanism. It's just that there will be some incremental cost of borrowing.
Can you break down, Vineet, the 520 crores of interest income in the operating part into MTF, interest income on your own money, and float money or client money?
That right now I won't be able to share. We'll once we upload the schedules, you'll have that data.
Got it. Fine. And finally, on the entire margin, what you give to the clearing corporation, can you give a broader breakup of the entire margin broken down into cash collected from the clients themselves and bank guarantee and lane on FD? I mean, you indicated that 40 crores is the cash and 15 crores is closer to your own money. But what amount is bank guarantee? Is it the same amount what you are borrowing, around 700 to 800 crores?
No, so we don't disclose the breakup, and I mean the underlying cash and cash equivalent which we give to the exchanges is in that range of 4,000 crores of client funds and the rest of our funds. How much of that is in the form of bank guarantee, that we don't disclose.
Got it. And last one, I mean, MTF income somehow has not done great for us in FY23. Any measures internally you have taken to build this book over FY24, where that additional source of income can come, which has struggled in 23?
Ketan, if you can take this question.
Yeah, so MTF, we are working on that strategy, to increase the book size and the market share there. So right now we'll not be able to disclose that, but yeah, we are on it.
But the trajectory is to make sure that in 24 the fund size or the lending portion should be much better than what you have expected, what we have witnessed in 23.
Yeah, so that's the plan.
Sanket, first of all, we are not too much dependent on margin trading book, because that is a kind of ancillary service given to a customer who is onboarding for stockbroking activity. There are lots of customers who do F&O and lots of customers who are doing on cash segment. So this cash segment is more dependent on market conditions. If at all we see a good rally in the market, they try to borrow more. So there would not be any linear kind of correlation between our revenue growth and growth in MTF. But having said that, we are working on lots of new products on MTF side. So we'll see improvement on that side.
Got it, sir. Thank you.
Thank you.
Just one correction. So a few minutes back I had mentioned the ESOP cost as 110 crores. The breakup of that into PSUs and the other stock options is PSUs is about 55 crores and not 85 crores, and the rest is again 55 crores.
So it remains same as last year, or almost same.
Yes, just that correction.
Yeah.
Thank you. We have a question from the line of Sanjay Kumar from iThought PMS. Please go ahead. Mr. Sanjay Kumar?
Hi. Yeah, thanks for the opportunity. So just one question. So I understand equity F&O structural trend since 2008-10. So, but what is happening in commodity ADTO? Because it's also growing exponentially. Are we enjoying the efforts of MCX, or is it down to what we are doing? Like, we have gone from 25% market share to 55%. It's a phenomenal performance. So just wanted to understand this part.
Ketan, if you can take this question.
Yeah. So, if you look at commodity, largely the new volumes are coming on the option side, and MCX is introducing, various products on the option side. Given the fact that, we were the early provider of options on our platform, on the mobile platform, that's the benefit that, we are getting today. And hence our, market share there is growing.
Okay. Is this also a structural trend like equity F&O, or is it linked to volatility in commodity prices, so it's more short-term in nature?
No, so MCX is bringing, lots of innovative products there. And MCX so options were lacking on that platform, which now we are seeing lots of traction there. So, those products are actually, helping business growing.
Okay. So right now I think it's at 4%, 5% kind of contribution. So can it go to double digits, or can it add more value for us going forward?
It would be, too early to quantify that, but we are seeing, good traction there for sure.
Okay, sir. Thank you. That's it from my side.
Thank you. We have our next question from the line of Sakshi Goenka from Sohum AMC. Please go ahead.
Yeah, hi. Thank you for taking my question. Just one follow-up on the margin funding. So supposing if secondary ASBA is implemented and all customers go for secondary ASBA, will that 4,000 crores on our balance sheet, which is in the form of trade payables, will that disappear? Is that understanding correct?
Sorry to interrupt. Aman, can you use your headphone, please? Your handset?
Yeah, can you hear me now?
Yes. Please go ahead.
Yeah, just a follow-up question on that margin funding. Supposing if secondary ASBA is implemented and all customers opt for it, will the 4,000 crores of trade payables which are sitting on a balance sheet disappear?
Vinay?
It's very early to comment on that because we still don't have any visibility of how and when this ASBA mechanism is going to get implemented. Whether it will become mandatory both for the clients or the brokers, or is it going to be optional? So it's very difficult to actually quantify anything.
No, but assuming that everybody opts for it because everything will be now blocked in your bank account and nothing will be coming to you guys. So is it fair to understand that 4,000 crores will not be with you?
It's a very hypothetical question right now. We would not be able to answer that because we have to look at how smooth and easy it would be for a customer to use that ASBA. Because we are dealing with customers who actually require funds, limits, and all that. So they don't appreciate even a delay of millisecond. So this whole banking system has to gear up to those kinds of transfers of funds and all that. So I would say this is a hypothetical question right now. We would not be able to answer it.
Sure, sir. Thank you so much. And so just one follow-up question. Hello?
Yeah.
Please go ahead.
Yeah, just one follow-up. Any timelines on appointment of new CEO?
We are looking out for an appropriate candidate, looking at what plans we have for next 3 to 5 years. So as in when we are able to identify a candidate, we'll announce it to the market.
Sure. Thank you so much, sir. Thank you.
Thank you. We have our next question from the line of Dikshit Doshi from Whitestone Financial Advisors. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations for a great result. Sir, we have around ancillary transaction revenue of around 258 crores, and so this is like over and above what we pay to the exchange. But generally, many brokers charge their clients on an actual basis. So is it we charge transaction charges to our clients with over and above the actuals that we pay to the exchange, and does this revenue is this revenue under risk of any regulatory thing? Because generally we've seen practices in the broking community that they charge on actual basis.
No, we charge based on actual basis of slab. So definitely our turnover in exchange is different, and client-wise slab is a bit different. So there is no concern thing that concerns us right now, because it is as per what business they want to promote, and what we charge is also within that regulatory framework.
Yeah. Okay. Okay. So because your volumes are high, you are charged at a lower slab by the exchange. That's what you're saying.
Right.
Okay.
Right.
Okay. And sir, in this interest income, our float income would be roughly around 200 crores.
Vinit, if you can take this question.
We are not disclosing the breakup of the float income and the interest income which we earn from client funding book yet. Once we release our full set of financials with the schedules, you'll have that.
Okay. And sir, since we are, what is the investment that we have done in our super app, and that investment is complete now, or and since super app is live and active now?
So, in terms of the capex spend that we've done, as I had mentioned earlier, it's in the range of about 30 crores, and the entire capex the spend has been capitalized since the super app is already live on the platform.
Okay. And if I heard you correctly answering one of the questions earlier, you said that you'll be distributing loan products, and we will also take the loan book in our book, or we'll take the risk, or we'll just distribute the loan products?
No, we would be distributor. Apart from this kind of stock broking and AMC business.
So it'll be a platform for loan. We won't take the risk of the loan.
No.
Okay. And my last question, sir, because we are generating a lot of cash, almost, and most of these products that we want to diversify is kind of a service and distribution kind of product, which may not require this kind of investment. So, what do you think about investing, this cash flow that we generate every year?
No, I think we have a decent dividend distribution policy to take care of excess cash, and we are definitely looking at lots of investment and opportunities in the market, which can help us grow our market share in other areas of services that we aspire to become leader.
And lastly, sir, by when are we planning to launch our own mutual fund?
Vinit, if you can just.
Yeah. So we got our in-principle approval as a sponsor in February, and we have some time to submit our final application. Once we submit the final application, the regulator takes anywhere between 3 quarters to 4 quarters to complete the processing and give us the final approval. Post that, we can launch our schemes. So technically, it's about at least 6 quarters away.
Okay. Thank you, sir.
Thank you. We have our next question from the line of Saptarshi Chatterjee from Centrum PMS. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations on great set of numbers. I have just one question. That you have said that the activation rate that has slowed down, it is across the board. But when I see your slide number 22, where you have given age-wise bracket of cohort-wise distribution of brokerage income, there I see that 2 to 3 years is a very high growth compared to other cohorts. Is it that their number of orders per client is very different from otherwise, or how to read about this slide?
Devendra would like to take this question.
Yeah. Hi, Saptarshi. So when you look at this slide, Saptarshi, this basically tells us the clients in various age brackets. So our main uptick of client growth started in FY21 when post-COVID, in fact pre-COVID and then post-COVID, it just jumped up heavily, right? As you look at industry as well. So what you are seeing here when you see 242 going to 845, this is the large influx of clients that came in comparison to previous 2 to 3 years that is being represented here. If you look at the recent time where I think we are acquiring at a very healthy rate of clients, that is a more clear-cut understanding of how the revenues are progressing in terms of that. But you look at the past data, our base before FY21 was pretty small. We have acquired a large base of customers, more than 1 crore since then, and that's what is representing when you look at this chart. So when you look at beyond 2 to 3 years, it will show a very significant growth in that particular year is what is visible from this chart. So you can't compare it from that point of view. But if you want to look at from this point of view, like I'll give you an example, the quarter 4 22 client, which is 1534 as a revenue number, that number, as we had shown before, if those clients have moved to second year, which is basically quarter 4 23, that has become 1329. So you can actually see the correlation with slide 7 where we've spoken about how the year 1 revenue and year 2 revenue of a client looks like. So this is the movement of client over 1 to 2 years, 2 to 3 years. So when you look at from a quarter four point of view, the same clients gave us 1534 in the first year, and the same clients gave us 1329 in the second year when they moved to the second year cohort time. So that's the way you read it. And post 2 years, basically the number of clients have increased drastically. That's why it's difficult to read in this chart at this point of time.
Understood, sir. Just one related question is that your slide number 7 beautifully gives the lifetime, like how the revenue is acquired for the client. But I'm saying for slide number 22, my question is that for less than 1 year's client, the revenue numbers actually is not growing much. Is it that concerns that the quality of the new incoming client is deteriorating, or like how do you read this?
So again, I think Dinesh also mentioned this thing. Whenever you look at revenue, looking at 6 months and 12 months period is the right way to look at it. Here we have presented a quarterly revenue breakup, the revenue that we got in the quarter 4, which was kind of a subdued quarter as well. So when you want to look at from that point of view, this number is not too readable. We have to look at from an yearly point of view to cover various kinds of market scenarios and a normalized revenue which is comparable in nature. So we cannot read these revenue in that one because they will have their market conditions of that particular quarter affecting it. But moreover, if you ask me from an overall point of view, we have seen stability in terms of the first year revenue that we are getting from the clients in the prior year in this financial year is what our models and what data we have played showing at this point of time.
Okay, thank you so much.
Thank you. We'll take a last question from the line of Anand Bhavnani from White Oak. Please go ahead.
Thank you for the opportunity. 2 questions. One is on insurance. So insurance is typically seen as a extremely high push product, and a lot of large players in this space, insurance distribution, they have call centers and they are setting up physical offices. How do you think of your insurance plan and your right to win in this segment?
Second question.
Yeah. So second question is on how do you see the impact of extension of ask for equity trading on your volumes? Do you have an expectation of how this should lead to change in equity volumes, and also can it affect your commodity volumes given that several of your customers might be doing both equities and commodities?
The first question, insurance, Saurav will answer that. But let me address your second one. The extension of time depends on how much they are going to extend. If they extend only till 5, it will not be a big impact on our volumes. Neither our cost will change because we are a digital player. Hello? Can you hear me?
I'm sorry.
Yeah, I can hear.
Yeah, you can hear. Okay. So if they extend it like a commodity market till midnight, then we will see a good increase in volume. Because people would like to take advantage of global market trends and all that. So we will see less of a gap up and gap down. That will create more confidence in retail that there would not be any overnight risk in equity market. So we are very hopeful if at all this time is extended till midnight, we will see a good improvement in market volumes and good participation from retail. On your first question on insurance, Saurabh, please you can answer that.
So we already have a very large sub-broker base and a very strong agent presence on the ground. That will obviously help us in building our insurance portfolio. Having said that, our core belief is insurance as an industry will also undergo strong change in terms of making things more digitized over time, and which is where our core B2C app and the focus on consumer value prop will come into play. So we'll not be pushing insurance hard like agents have done over the past. I think that is not the core agenda. If that answers your question.
Sure. Thanks and all the best.
Thank you. I would now like to hand the conference over to Mr. Dinesh Thakkar for closing comments. Over to you, sir.
Thank you for joining us on today's call. I hope we had been able to answer all your queries. Should you require any assistance, please feel free to get in touch with Hitul Gurkha, Head HR, or SGA, or Investor Relationship Advisor. Good day.
Thank you. On behalf of Angel One Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your